investment ideas. Let's welcome in David Stryzewski with us, CEO of Sound Planning Group, to talk about picks and such. But first, let's just get your feel on the market. I mean, we did have a winning week last week where all the major averages were up over 1%. Now what?
Great to be with you, Nicole. So I think one of the biggest mistakes that investors could be making today is just believing that this banking crisis might be over. I mean, I vote that it's over, but here's the reality. We still have a lot of challenges that are within the market. And so from a big macro perspective, I think that we've got a lot of fear, uncertainty, and doubt that's still left in the system, especially given the fact that, the biggest change right now since the Fed has come in and intervened so significantly is that the cost of capital has really changed the dynamics of our economy. And so if we think about that and the cost of capital, and we look at the lending requirements that are certainly getting tighter, if anyone's gone in and tried to look at, getting new debt right now, we have over $1 trillion of debt that needs to be remetabolized, renegotiated here in 2023 through corporations. And so this is a significant concern to me, given the fact that we had so many IPOs and so much venture capital money that was going into SPACs and different things that take more capital to run than they actually produce. And so if we find ourselves in a place where the cost of capital is so much higher, at minimum, if they get these deals done, margin compression is going to be in there. And ultimately, I think that we could be heading towards an earnings recession here over the next couple of months, which ultimately leads me to this idea that I think that we're going to see more bankruptcies in the coming months, or at least Chapter 11s, where companies are going to be looking at their debt and saying, you know what, we've got more debt than we can ultimately handle here. We need to renegotiate some of this stuff. If that's the case, investors need to be very, very, very cautious, especially if they're holding bonds and they're holding those stocks, because they will be downgraded and there will be significant losses in those specific investments.
Yeah, and the cost of capital, as it's been on the rise, people have had to go out and basically raise more funding, and it's just not easy, particularly in an uncertain environment. So I guess you're more apt to go to certain sectors over others, or even within a sector, one area may be better than the others. One area that's showing a little strength today, and that is oil. Tell me about oil and gas and what you like there.
Sure. So if we look today at the just overall market and an understanding of what's important, what's not as important, I mean, oil and gas is not necessarily as popular right now in the United States, given, Biden's fossil-free agenda here, at least as it relates at home. But ultimately, they've got some of the best free cash flow that's out there right now. So if you're looking at places that should likely maintain strength, I think that that's important. I mean, also, looking at things like Saudi Arabia and Iran on the 21st here just entered into a deal. They were sworn enemies, and now, those are two major oil producers that are now also even aligned with Russia. So, we're seeing, some changes here taking place. So I think that, we see even one spill, one challenge, the price of oil is going to go up significantly, even if we have a declining economy. So we need diesel to run things, to produce things, et cetera. And so it's very important that we're paying attention to this sector. And so I think that as the year continues to go forward, it's going to be seen as an area of strength and perseverance.
Right. I understand. And then when we turn our attention to something like gold, where gold crossed 2,000, but now past 2 days, right, it's been down. Your thoughts there? We have gold and silver on here.
Yeah. So I've been saying this for a while now. I think that gold and silver are, asset classes that are not necessarily as looked at right now. And the reason for that is because it's trade in U.S. dollars. Now, if we look at gold and silver relative to other currencies that have lost value over this last couple of years, then I think that we see a different story as it relates to gold and silver. As we're looking at things right now, central banks are buying gold and silver faster than ever before. But one thing to also consider are the miners. Typically, the price of the gold and silver, which we've just seen, rise very significantly here in 2023, the miners have not risen accordingly. And so I think that they're undervalued right now, and I think that there's going to be an opportunity to see some real lift in that specific sector.
Understood. Okay. And then when it comes to real estate, and this is what I meant about even within a sector, you might see differences. For example, office buildings, they're having to go out and raise more capital, right? Versus other parts of real estate, maybe you have medical or senior citizens or storage, right? Those seem to be doing better in the real estate world.
Absolutely. You know, the big concern here is that people are working from home right now. And a lot of the commercial real estate that, has typically been in downtown areas like New York. I heard a new statistic that 22% of New York is now empty. I think that there's a lot of employers that are waiting to right size or downsize their specific footprints because they got more people that are out and about. And so those deals are tough to make happen. They don't have 30-year mortgages like everyone else. They got like 10-year. And so I'm bearish right now on commercial real estate, specifically office spaces. But just like you said, I'm bullish on multifamily, senior housing, student housing, data centers, distribution centers, warehouses, especially in places where Amazon might want to be. But there's a number of things that we could be paying attention to, at least as rents maintain their strength.
Yeah, understood. And don't forget, New York is a very expensive city. Your dollar doesn't go very far. I mean, what's a dollar? $0 here. Let's talk about, right? I mean, if I have a dollar, I might as well not leave my house. Talk about defense contractors, bond alternatives, just quickly, the rest of the ideas here.
Sure. So I think defense contractors are an important one. Obviously, this is a theme that makes a lot of sense if we see, a Cold War in Russia-Ukraine become more of a hot war. Obviously, we just saw, China show up in Russia last week. Now they're the diplomats of the world. And they've said that they're going to be, working with one another very closely going forward. Ultimately, United States makes better weapons than anybody. We are very low or depleted, and because of all the outsourcing we've been doing to the Ukraine here. And so I think that we're going to see some appreciation in some of those areas because we have to prepare. God forbid World War III ever happens. Lord, we pray that that doesn't occur. But as far as bonds go, I just want to caution people that as we see this credit crisis developing and continuing to go forward, we're just in the first month of this, really. It took a year before Lehman and Bear Stearns and Fannie and Freddie and Washington Mutual ultimately came apart. If you own the bonds of some of these organizations, even if they're A-rated, and they get downgraded, or we see interest rates rise, or we see these organizations default or file Chapter 11, we're going to have massive losses to the quote-unquote safe place that people are hoping and depending upon as they're nearing or entering retirement, or specifically to hold their portfolios. So the specific idea that I have right here is just based on math and science, but there's an asset class that not a lot of people are paying attention to, and that's called a fixed indexed annuity that has the ability to make some of the gain of like the S&P 500, but more importantly, none of the pain if everything falls apart.
Right.
And so these are, giving double-digit return potential right now. Even the fixed rates inside of them can be higher than 4%. And so, that can make some sense. They've got some liquidity, and I think that might look like a safer alternative today to specifically bonds that, all 5 of these ways that they could lose. I think we've got some challenges, and they're all on the table.
All right. Good to see you, David Stryzewski. Thank you, CEO of Sound Planning Group. Thanks, David.